to another episode of Managing Your Money. I'm Adam Strauss, partner at Pekin Hardy Strauss Wealth Management, and I'm here with my colleagues Bill Pekin, Matt Bloom, and Josh Strauss. And we're here today to talk about, I think, an important and timely topic, which is the rise of long-term interest rates that is occurring today and roiling the markets. I want to start this discussion by just setting the table by presenting some facts, and then we can spend some time with some analysis. Presently, the national debt of the federal government of the United States is $33.4 trillion. The government debt to GDP ratio of the United States is currently at 123%. As recently as 2000, less than 25 years ago, it was only 55%. The situation is accelerating to the downside as spending is currently exceeding tax receipts by about $2 trillion annually. And interest rates are rising across the yield curve, which means short-term bonds, medium-term bonds, and long-term bonds. But in this conversation, we're going to be focusing on long-term Treasury bonds, long-term debt, and the rising interest rates that go along with that long-term debt. In this respect, I have three charts that I just want to share with everybody. Again, just trying to set the table here for everyone. Okay, can everyone see this chart? This is a chart that Josh created from Fed data. This shows the yield to maturity of the 10-year Treasury. And what you can see here is that it's currently above 4.75%. But importantly, as recently as 2020, the 10-year Treasury yield was less than 1%, less than 1%. That I think is sort of like, a 5,000-year low. We talked about this in a quarterly letter a couple of years ago. But since then, there's just been a remarkable rise in the 10-year Treasury bond. Second chart. This is a chart of the TLT ETF. The TLT ETF is an ETF that holds long-term Treasury bonds, primarily bonds that mature 20 years plus. And since 2020, when that long-term yield bottomed, the TLT bond price has declined by more than 50%. And the drawdown in these long-term Treasury bonds is greater than the drawdown that occurred in stocks during the financial crisis. It's occurred not over a few months, but over 2.5 years. But nevertheless, it's been an enormous drawdown, and that drawdown is completely related to higher interest rates. Third and final chart before we go into questions is here's a tweet from Jim Bianco of Bianco Research, where he shares a chart of the MOVE index. The MOVE index is sort of like the volatility index for the Treasury bond market. And what you can see is that the volatility index is increasing to the point where it's more than one standard deviation above its long-term average. So there's a lot of things going on right now, none of it good for the Treasury bond market. Austin Goolsbee, the Fed governor of the Chicago Bank of the Federal Reserve, last week said, "I'm still trying to process why long-end interest rates are increasing." So let's start with that question. I think we're processing it too. We're going to be processing it right here. Why are long-term interest rates increasing? Matt, why don't you start?
Well, I think there are a lot of different drivers for it, but obviously inflation is one, right? Buyers, long-term treasuries want to be compensated for the increases in inflation, right? They want to get potentially a real return by owning U.S. treasuries. And with inflation continuing, like basically coming back up now a little bit, we're starting to see that tick back up. I think buyers of treasuries are demanding higher rates to compensate for that increase in inflation. I think there's also There's a lot of fear among buyers of treasuries that the U.S. government balance sheet is getting out of control. We're despite being in peacetime, we're basically spending like we're at war. And we're running enormous deficits at the federal level, and so the balance sheet of the U.S. government just continues to deteriorate, which has a lot of implications for their ability to extend future debt. And then there are the dollar is strengthening, which globally is forcing other central banks to protect their currencies. So there's potentially selling by other foreign holders of U.S. treasuries, adding to that pressure. So I mean, there's a number of different reasons. There are probably a handful more that Billy and Josh can add as well, but I think those are some of the big drivers right now.
Yeah, thanks, man. I'll jump into. I think one of the things maybe you touched on this was the massive amount of supply coming. I think something like 40% of all treasuries are coming due, outstanding are coming due in the next 2 years or so. What is unusual about this cycle is that every borrower except for the federal government has turned out its debt. So when interest rates were artificially low or certainly at all-time lows because of COVID, most people were able to refinance their mortgage at lower rates, and most corporations went and refied their debt at lower rates. Most of the private sector took advantage of the historically low interest rates that we've seen over the last 5 years. But the entity that did not do that was the U.S. government. The U.S. government did not term out its debt. It's a little bit head scratching as to why that hasn't happened. There's some speculation that maybe the government couldn't place large amounts of debts at longer durations. But whatever the case is, the government now is the one who needs to refinance roughly 40% of their debt in the next 24 to 36 months or so. And that's a lot of supply hitting the market at the same time, as Matt was talking about, that our deficits continue to increase. And so there's more treasuries that are coming due or becoming available all the time. There's just a torrent of bonds. And while that is going on in the background, the traditional buyers of treasuries, namely China, Japan, and the Gulf states, are stepping away. China's holdings of treasuries are down 30 to 40% from its peak of, 7 or 8 years ago. So the customary buyers aren't buying. So you have a lack of buyers, you have a huge amounts of supply, and that supply-demand mismatch is causing rates to rise.
Interest rates are increasing. We've talked about a lot of the factors that are driving the increase in interest rates. Why is this important? I mean, if you don't own long-term treasury bonds, and I don't think, generally speaking, we do with any of our clients, why should an investor care about rising long-term interest rates on treasury bonds? Why does it matter that long-term treasury interest rates are increasing?
Well, long-term interest rates are this is the 10-year treasury is the ultimate benchmark bond. And with rising interest rates, what it does is it makes the value of all financial assets decline, because the stream of cash flows associated with those financial assets in today's dollars is lower at higher interest rates. So if you go across every asset class, if you're looking at a bond, as long rates rise, all bonds, whether it's an investment grade corporate or municipal bond or high yield bond, they all are priced off of treasuries. And so if the 10-year treasury is yielding 4.75% and the GE bond is 150 basis points above it, that's pretty expensive debt for them to borrow in order for them to build a new facility. So the ability for corporations and governments to reinvest back in the economy is a lot more expensive than it used to be. And so valuations will come in for stocks, for bonds, for most assets. There are assets that are that benefit positively from higher interest rates, but there's very few of those.
Good. Anybody else have anything to add to that?
Well, don't forget the heavy stress that it's putting on the treasury market. Look at the government. I mean, their ability to fund themselves at these higher and higher and higher rates, it eventually gets to be where it's mathematically almost impossible for the government. I mean, it creates a spiral, right? So higher rates increase the debt service costs for the government. They have to issue more debt to cover just the interest costs, which causes rates to go even higher because it creates more supply. And so we get into this spiral of increasing debt service costs, and just on and on. So these higher rates mean that it starts to crowd out everything, and then you create enough stress in the Treasury market, and all bets are off across all markets.
And I'll just add one more thing. As you know, as Josh and Matt were talking about, as rates rise, it affects the cost of capital for everything else. So the 10-year Treasury really affects mortgage rates. You see mortgage rates are generally priced off 10-year Treasury bonds, and you see mortgage rates now piercing 8%, which is the first time they've been that high, and I don't know, since the mid 90s perhaps, or maybe early 2000s. The higher mortgage rates are, everyone knows, puts a damper on housing activity, and all else being equal, on housing prices. Although we're talking about the long end of the curve, the Fed, for a moment, we'll talk about the short end, and the Fed has certainly been tightening and increasing rates at the short end. And to Josh's point, most financing is all priced off either the short end or the long end of the curve. So as the curve rises, as rates rise, that means that home equity lines of credit and lines of credit to companies and floating rate bonds are all getting more and more expensive. So all else being equal, the economy will slow down and face headwinds as the cost of financing goes up. And so that's usually a bad thing for economic activity. I'll just say one last thing. If you looked at that chart, Adam, that you first brought up that Josh created of the 10-year Treasury yield from, I don't know where it started, from the 70s or maybe early 80s, I can't remember the start date, up until today, it's a series of lower highs. In other words, up until recently, the Treasury bond yield was declining. Since 1986 or so, it's been declining. And every time, at least in the last 35 years, that 10-year Treasury got too high, something in the economy broke. There was some financials, usually a banking or real estate crisis, because all those entities, or many entities, are tied to financing. So one of the biggest dangers of rising rates is that it causes financial pressure and stress on the economy. And historically, at least, once rates got too high, something very large, usually a financial entity, broke in the economy, which then caused a lot of economic uncertainty and calamity, and then started the new cycle of rates going lower, at least for a period of time.
Yeah, so that's an excellent point. That historically, when we've seen interest rates rise, that rise has usually occurred until something breaks, and that something breaking ends up prompting a response, generally on the part of the Fed to ease monetary policy, and on the part of Congress to pass some kind of a stimulus bill to boost the economy. We saw that to the nth degree in 2020 when the economy shut down. The Federal Reserve came in and bought every single bond in sight, and Congress passed the largest stimulus bond in history. I think it was well over $1 trillion, and just an incredible amount of stimulus, which set the stage for a lot of the inflation that we're seeing right now. But I think that Matt sort of talked a little bit about the impact on the U.S. government. I mean, it seems like, based on what Josh and Billy are saying, it's definitely not good for almost all financial assets. It just creates financial pressure everywhere, and we're seeing that right now in the stock market. The stock market's been terribly weak over the last couple of weeks. Credit spreads have been increasing. I mean, it's not going straight down, but it's definitely under strain. But I'm kind of interested in this point that you made, Matt, about the strain on the U.S. government. And I mean, it's sort of reminded me of what Ernest Hemingway said about going bankrupt, that it started gradually and then all suddenly. And I mean, are we moving into the sudden phase of the becoming bankrupt? Are we headed for a debt crisis? I guess that's my next question. I mean, are we headed for a debt crisis in the United States? Is that what these rising interest rates are showing? And what is the end game here? What causes this situation that seems unsustainable to stop? Who would like to take that one?
Oh, I'm happy to lend an opinion. Yeah, I mean, it was Reinhardt and Rogoff, who were kind of the big economists who wrote a seminal book on debt and societies circa the 2008-09 crisis, and were very much in vogue during that time period. They basically did a study over the last 100 years, and they said every time both a developing or a developed nation got to a debt to GDP level of north of 110%. And as Adam started off this call, we are roughly at 120% of debt to GDP. Every time in the last 100 years that has happened, there's been three outcomes in any order: hyperinflation, inflation, or default. And I'm not saying that we're going to get into a hyperinflationary environment. I think that's unusual. I'm not forecasting that. It's unlikely, since we have the reserve currency, that we will default in our debt, because we can always print our debt. Countries that tend to default on their debt usually borrow in the dollar and can't print the dollar, so they owe dollars and they don't have enough dollars, and so they default. We, as a printer and the owner of the reserve currency, can't technically default on our debt. So that really leaves the last course open of inflation. And if I think at this stage, that really is the only recourse that we have left. Now, does that qualify as a debt crisis in the way that you're saying, Adam? I'm not sure, but certainly hit by historical standards, our debt to GDP is very, very high. And the least painful way to get that debt to GDP ratio down is through a period of inflation, to inflate away those debts. And that will bring some type of crisis with it. Like high levels of persistent inflation are not good for economies. We saw that in the 1970s most recently. So I think we are in some sort of debt crisis. I think we need to get our government's debt down to a more reasonable level. I think it's going to cause some pain and some adjustment for many years.
If you're
Billy, if I can jump in here.
Hold on. Josh, why don't you start?
Sorry.
But in order to get the debt to GDP down, right? Either the solutions are either getting growth up, right? Which there's only so much control the government can have, fine, and they've been pouring money into the economy for years, and it's hard to see them doing that. And then the other is finding ways to cut the deficit, and you can either raise taxes, which is unlikely in the current government. There's just too much gridlock in Washington, or you can cut expenses, and most of our expenses are either defense or entitlement programs. Well, given the fact Adam mentioned earlier, we're basically in a Cold War with China and Russia. Defense spending ain't coming down anytime soon. There's very few politicians that get reelected for making any kind of negative changes to Medicare or Social Security. So it seems like we're just between a rock and a hard place, and I can't see how we get out of that.
Matt?
I was just gonna comment in response to something that Billy said. He said, we're likely to see this inflationary sort of path. And he said, I don't know if that qualifies as a crisis. And I was going to say, if you're a fixed rate lender, it'll feel like one. That the bondholders at fixed rates will get killed, and much like they did, post World War II in the United States. But to go along with what Josh is saying, that I don't see the political will in the United States to cut spending. I don't see the political will to increase taxes. And I think the only route is yield curve control, right? You let inflation run hot, you suppress rates, you try to get nominal growth up, at a basically nominal growth of the economy higher than the growth of the debt. That's it. I mean, that's
Can you take a moment and just, what is yield control? What is it, and how does that work?
Yes, it's where the rate of inflation is above. It basically allowed to stay above the interest rate level, so that so that basically it's negative real interest rates for an extended period of time. Where the central bank caps the rate of interest rates such that real interest rates are negative for an extended period of time, and that over time that brings down the debt to GDP percentage, because GDP nominally grows faster than the debt does.
So basically what you're saying is the end game here is that something breaks, the Fed eventually capitulates, and that capitulation involves basically printing money to buy all the Treasury bonds that need to be bought in order to get yields down from, say, get the 10-year from 4.75 to whatever, 3 or some, some
whatever level it is.
some much lower level than where it is today. Is that right?
That's my belief on what the policy will be. We've seen it before, but yes, your description of it is effectively what I'm envisioning, and I think that I think Billy and Josh probably have similar ideas. I mean, it's a policy that's been put into place in the United States before. It's been done in Japan. It's been done in other countries, so it certainly wouldn't be a first.
Right. So it just interrupted. I mean, the last time our debt to GDP was this high was after World War II, which somebody mentioned, right? And the policy that you're talking about, Matt, was put in place in this country after World War II. The Fed essentially capped the 10-year roughly at 2.5%. I can't remember quite what it was, but they capped that 10-year rate and they let inflation run hotter than interest rates for at least like a period of around 10 years until that debt was inflated down. They souped up growth and they held, right? So growth was higher than, or inflation or growth was higher than the kind of the nominal interest rate, and so that debt got inflated away and interest costs got suppressed. You're seeing it happen right now most famously right now in Japan as well. Japan has the Bank of Japan has a kind of a ban, an allowable ban of which they will allow the 10-year yield to trade at. And inflation today in Japan is much higher. I think that the upper limit of that 10-year band in Japan for the 10-year Japanese government bond is 1%, and inflation in Japan today is running north of 3%. Maybe it's as high as 4% today. So they have effective yield curve control going on in Japan, which is another nation that is very much has a very large debt load as we do.
So I think what I'm hearing in terms of the picture that's being presented here is the U.S. Treasury has a big problem because they're going to be issuing more and more Treasury debt that is not being absorbed well by the market, which is causing interest rates to go up more and more. And eventually it's going to break something. The Federal Reserve is going to come in, is going to cap interest rates at a low level by printing more money, which is probably inflationary. What is an investor to do? What do you want to own? What do you want to avoid in a economic and market environment like the one that we're in right now and that we're talking about is going to be occurring? How is a person to invest to either make money or at least protect what they have?
Well, I think you're going to see, if I can jump in first, if you see yield curve control and or an extended inflationary environment for the intermediate period ahead, you're going to want to look at securities where gold's going to be good in an inflationary environment, much like the 70s. It's going to be good, basically whenever real interest rates are negative. So that's gold and gold miners. Beyond that, real assets, whether it be, real estate or other commodities, oil, things that did well in the 1970s. In the 1970s, in real terms, the only asset classes that had a positive rate of return, was, physical gold and oil companies. And so I think you might see that same sort of thing. But, if you've got a real pullback on growth, it's going to be hard for a lot of businesses to create sustained growth in earnings and keep their valuations up. So I stocks are going to be weak. With bonds for the near term, I think you got to stay short. With the inversion of the yield curve, you can buy 1-year bonds right now 5.5%, and those you've got basically no interest rate risk and no credit risk and no liquidity risk, and you can sell it at any time and deploy it in more attractive assets as valuations come in. So that's what that would be my thought right now.
Yeah, I don't have a lot to add. Well, I think Josh is spot on. I think at the short end of the curve, if you're being paid very high rates like you are today at north of 5%, I think you're safer at the short end of the curve. As someone said before, inflation is the enemy of long-term debtors. So if you own a long-term bond and we are going to ramp up inflation, you don't want to have long duration, because on a real basis, your real returns will be eroded over time. And if the 70s or 30s or whatever was any guide to, or aughts is any guide to what does well in an inflationary environment, then it's, as Josh said, it's real assets and commodities that usually thrive in an inflationary environment.
Matt, do you have anything to add?
No, I mean,
I'll add one thing, which is, I think I probably bought more short-term treasuries in the last year for clients than I have at any point over the last 2 decades. It's attractive. I mean, you're getting a yield on short-term bonds that's higher than inflation. And as Josh said, you don't have credit risk, you don't have interest rate risk. So it's almost like, as an investor, it's pushing the easy button. I mean, it's just, if you can get high return with low risk, why not? And so at the moment, tactically, it seems like an exceedingly good idea. But as a long-term investment strategy, it seems to me like the time that this is going to be attractive is going to be limited. I mean, going back to what you were saying, Matt, about yield curve control, if the point of yield curve control is to get interest rates well below inflation, what we have with short-term bonds right now is just the opposite. We have short-term interest rates well above inflation. And so it seems to me like if you want to get the debt to GDP down, then there's going to come a time, I don't know if it's weeks from now, 6 months from now, or a year from now, I don't think it's multiple years from now, where they're going to have to, where that yield curve control gets put in place, and the time to own short-term treasury bonds, because it's low risk and very attractive, is probably going to end. Would you agree with that, Matt?
I do agree with that. I think that's a tactical investment strategy that is a great idea right now. It's a place to sort of hide out, waiting for some of these, waiting for something to break, right? And waiting for the next phase of this, this sort of unwinding. But I don't think you're going to want to be there, 24 months from now. We're not going to. I don't think we'll see these same yields or even close to it a couple years down the line. So that's when you want to be an owner of gold. You want to be an owner of energy, agricultural commodities, etc. As Josh and Billy mentioned.
Okay, great. So we're running low on time. Any last minute thoughts that anybody has that they would like to share that we haven't discussed yet?
Well, I had a question I wanted to pose to Matt based on that last comment, which is, if you think that short-term treasury trade at 5.5% isn't going to be there in 2 years, and you're going to want to be elsewhere, what's the treasury? What are the treasuries going to be looking like that you're going to be wanting to be elsewhere? You're going to see the yield curve control? Is that what you're saying?
That's my belief. Yes, that a couple years down the line, we will be in a situation where the Fed is capping rates at a level that's it's not attractive from a real return standpoint.
Right, and so because it'll be real yields will probably be low if not negative, then they would say that that would make sense for you not to be associated with a longer term treasury too, right? Even though rates could be coming down because of capping.
Right. I think it's going to be across the curve, so I don't think you want to necessarily be at that point owning anything in the treasury market. That's a good way to erode the real value of your portfolio. But with that said, like we were discussing right now, those short-term treasuries are a great place to be because you are getting paid on a real basis to own those at a time when a lot of other types of assets are not attractively valued, right? You know, you look at the broader stock market, and those assets are largely unattractive, and so, you know, short-term treasuries are a great place to be right now.
Well, this is a fantastic discussion. I think we talked about a lot. You know, I think I understand the issue better than I did at the beginning of this video. So I want to thank Billy and Matt and Josh for your contributions to this discussion. And we're going to wrap up this latest episode of Manage Your Money. Thank you for watching.